Discounted cash flow, or DCF, analysis is a valuation method used to estimate the intrinsic value of an investment, such as a stock, company, or project, based on its future cash flows. Here are its key aspects. DCF analysis is a method that calculates the present value of projected future cash flows, discounted at a rate reflecting the investment's risk and the time value of money. The result is used to determine whether an investment is overvalued, undervalued, or fairly priced. Free cash flows, or FCF, represents the cash a company generates after accounting for operational costs and capital expenditures, often referred to as CapEx. The formula is FCF equals EBIT times 1 minus the tax rate, plus depreciation and amortization, minus changes in working capital, and minus CapEx. The discount rate, commonly the weighted average cost of capital, or WACC, is the rate used to discount future cash flows to their present value. WACC accounts for the cost of equity and debt, calculated as WACC equals equity over equity plus debt, times the cost of equity, plus debt over equity, plus debt, times the cost of debt, times 1 minus the tax rate. E stands for equity, D stands for debt. RE is the cost of equity, often calculated using CAPM, and RD is the cost of debt. Terminal value, or TV, accounts for cash flows beyond the forecast period, assuming perpetual growth or an exit value. There are two common methods: the perpetuity growth model, where TV equals FCF in the final year plus 1, divided by the discount rate minus the growth rate, and the exit multiple method, which uses a multiple of earnings or revenue. The time horizon is the projection period, typically 5 to 10 years, for estimating future cash flows. Forecast free cash flows by estimating the FCF for each year within the projection period, using historical financials and growth assumptions. Next, calculate the present value, or PV, by discounting each year's FCF back to its present value using the discount rate. The formula is PV equals FCF at time t divided by 1 plus r raised to the power of t. Then, determine the terminal value by calculating the value of cash flows beyond the projection period using either perpetuity growth or exit multiples. Sum up the present value of all forecasted cash flows and the terminal value to get the total value of the investment. Finally, compare the calculated intrinsic value to the market value or price to determine if the investment is undervalued or overvalued. Revenue growth involves making assumptions about how a company's revenue will grow over time. Profit margins require assumptions about operational efficiency and profitability. The discount rate reflects the riskiness of the cash flows and the opportunity cost. And finally, the terminal growth rate represents the perpetual growth rate of cash flows, which is typically between 1 to 3% for mature companies. One of the key advantages of DCF is that it focuses on the intrinsic valuation of a business, independent of market sentiment. It's customizable, allowing you to incorporate specific assumptions about growth, risk, and cash flows. Plus, it's time-sensitive, reflecting the time value of money, making it particularly suitable for long-term investments. However, DCF has its limitations. It's highly sensitive to assumptions. Small changes in discount rates, growth rates, or cash flow forecasts can significantly alter the valuation. It's also complex, requiring detailed financial projections and a thorough understanding of the business. Additionally, it's limited by forecasting accuracy, as future cash flows are inherently uncertain and subject to market or operational risks. And it's not suitable for all businesses, particularly those without consistent or predictable cash flows, such as early-stage startups. Let's consider an example of DCF valuation We have a forecast period of 5 years. The free cash flow for year 1 is $10 million, growing at 5% annually. The weighted average cost of capital, or WACC, is 8%, and the terminal growth rate is 2%. To calculate, we discount the free cash flow for each year, then calculate the terminal value at the end of year 5. Finally, we sum up the present value of the free cash flows and the present value of the terminal value to get the intrinsic value